Hello, my name is Darren, and we are members of something called the International Business Structuring Association, or IBSA. Essentially, it's a network of professionals that serve clients, private clients, or families that are exposed to multiple jurisdictions and they're running businesses, entrepreneurs. So it's not just restricted to tax, even though we're going to talk about tax. It'll be like investment migration, IP lawyers, insolvency, just anything to do with what the family will go through as they cross borders. And with that, I'd like to introduce you to the panel. Jose, you're going to start from your side and introduce yourself.
Thanks everyone to join this, and thanks Darren and Step 80 also for our participation. I'm a tax partner in Squire Patton Boggs, based in the Madrid office. I do international tax, even though I could sound probably American, because my mom's American, my dad's Spanish, and I'm actually probably the only one not talking about U.S. taxes here, but some of the additions around that, which is always great to hear. Everyone living outside of the UAE, like myself, is excited to come to a place where Texas is a friendly environment for Texas. So you got to stay away of our tax network around how the trends, the difficulties around kind of keeping the taxes low, and especially with U.S. citizens. So happy to be here and try to contribute to this discussion.
My name is Reassess, and I'm the founder and CEO of Esquire Group. We provide international tax and wealth planning services to affluent multinational families and help them minimize their taxes and pass their wealth to the next generation in a tax efficient and organized manner.
My name is Vince Trung. I'm based here in Gate West with a company called GSD Capital. I'm from California. I'm an American CFP, so I do financial planning, financial modeling, asset management for clients, and I've been here 16 years now.
Given that we're in this really dynamic landscape, a lot is changing. I know lots of you are advisors yourself. Vince, do you want to comment on what you can do as an advisor who works with potentially U.S. exposed individuals or families? Just preparing portfolio financial planning?
Sure. In my industry, which is asset management, it's often said that you can never say that this time is different, because supposedly this time is never different. Except I think this time actually is different. The human brain is wired to take the recent past and extrapolate it indefinitely into the future. And so we don't adjust well at inflection points. We are blind to inflection points. I'm not saying that there is definitely an inflection point, but in my lifetime there is a potential for an inflection point like none other that we've seen, and a total restructuring of the world as we know it. And therefore, for investors, if you've been investing for the last 15 years, and you just put your money in an index or the S&P, you've done very well. And if you invested in the US, you've outperformed virtually every other major stock market in the world by a very wide margin. But what I'm getting at is there is a potential that things are going to change. We need to be on the lookout for that change, and we can't just blindly assume that the US is going to keep outperforming the rest of the world as it has for the last at least 10 years. But year to date, European equities, especially converted to US dollar, is outperforming the US by about 16%. I have not seen that wide of a spread that's been this persistent, and it's only been 5 months. I've never seen that since the Great Recession. My point is, I think we need to be open to the possibility that past is not prologue.
Just to take that one step further, for these advisors here who advise families to do portfolio as well, what are 3 concrete steps they should be taking right now to prepare?
I think first of all, I don't know how concrete this is going to be, but I don't know how many are actually Americans or people with U.S. assets and U.S. interests. But first I want to say that this is not the time to be political. You need to really be aware of your own biases when it comes to U.S. assets. When Liberation Day was announced, it was much bigger than anyone thought it was going to be. Most of my clients have been with me a long time, and maybe only like 5 or 6 were really concerned. But the 5 or 6 who are really concerned are the more left-leaning, Democrat-friendly people. And I'm not particularly political. I'm concerned about the economic well-being for as much of the country as possible, and for myself and for my clients. But they are obviously much more in a panic mode because they're already biased against President Trump, versus those who are more right-leaning. Oh yeah, this is not a problem. He knows what he's doing. Everything's going to be fine. Well, you can't just simply conclude that as well. But I guess what I'm saying is just be mindful of your own, any particular biases you might have right now, and look at your assets and just be very, very flexible. We need a lot of flexibility over the next few months, depending on what does or does not happen with the tariffs and the trade deals. And we're going to have to do some adjusting if, what could possibly happen right now. no deals get done, I'd be prepping for a recession. Some deals get done, and particularly with the major trading partners, we would probably have a slowdown, but not have a recession. And deals get done with the vast majority, which I don't think is really likely, or they remove the 10% tariffs, then, we should be all in.
I think this is just more in general, not so much to do with tariffs and the current administration, but I think that as advisors, when dealing with the United States, it's always important to think about the tax aspects. I mean, especially when we're talking about, for example, owning stocks or any sort of U.S. property. And I think the U.S. is obviously a litigious society too. So, asset protection, liability protection, things like that. I think the U.S., whenever you're doing business with the U.S., you're investing in the U.S., you have clients investing in the U.S., you don't just want to jump into it. There's a lot that can be done for liability protection. There's a lot that can be done to minimize, reduce, sometimes eliminate taxes, but the planning needs to be done in advance, because if the investment or whatever it's done, or whatever it is already done, usually restructuring that has a significant cost. It's just not going to be worth it.
I mean, just to add on in line, as you said, now it seems like, the market in the U.S., before you look at that, it's an example for the world that in the last 20 years, it has been a lot more profitable than any market, right? And I, Spanish, have suffered like too many crises over the last 15, 20 years that I've been working, right? And we say, okay, why when the market goes up, the U.S. is higher than your own? Why when the market goes down, yours goes right? In Europe, we're always feeling bad for ourselves, right? And I guess there was this last year, there's been a different shift on that. And that, eventually if it considers, one of the points that I think is relevant for tax purposes is that, for U.S. citizens, and you said the tendency is to have U.S. products or U.S. stocks directly because you can't invest in European investment funds because you have that consideration of prefix that maybe we touched on before, tax transparency, all those issues. So the point is, if you're a U.S. citizen, you're looking at investing in stocks. If you look at outside of the U.S. market, you're looking at investing in, French stocks, UK stocks, German stocks. And then what happens with those? Then you have dividends. One of the things, you have withholding tax. Withholding taxes is a big issue, and you need tax-free protection. So now we have a U.S. citizen, which is a UAE resident, which invests in Europe. So now you're looking at, the U.S. will tax their long-term capital gains interest 20%, there's different brackets around that. But now you have, I'm investing in a German country. There's a 27% withholding tax. There's no tax. Then I have to look at whether it has a tax treaty with UAE to protect me. In the case of Germany, there's no tax treaty. One of the things that I raised is that the UAE has a pretty good tax treaty network, but in some ways, it's standard. Because, for example, the Spain treaty, I wrote down a bunch of the Netherlands, Dutch tax treaty, the Canadian, they only apply to UAE nationals. So you can be a tax resident in the UAE, for local purposes, but you don't get the benefit of the tax treaties. So when you live in the perfect world, no taxes in the UAE, then you bear, doesn't apply for U.S. citizens because you end up for dividends. But a lot of times I see UAE resident receives dividends from the U.S. and they have a 30% withholding tax. There's no tax treaty protection because there's no tax treaty with the U.S. So then you're looking at a perfect market, a perfect world with no taxes, and then you bear 30% of your taxes. So, in a changing world, as I said, we all see cases where, you're a citizen here, but your daughter is studying in Spain. My husband is married a UK person living there, and then I'm planning with a trust structure. It doesn't happen. So these are the complex world, and there are solutions to it. So that's what advisors, not only tax, wealth planners, that's where we get the legal support and we can advise. So it's just, in a beautiful world of Texas, right, there's ways for planning.